typically when you bump into this, it's the person who has a $500,000 mortgage and is 78 years old. They can't cover the $500,000 mortgage because they don't probably qualify for it, or it's going to be extremely expensive for that individual. Doesn't make logical sense. So that's when this concept comes into play. So I'm going to go ahead and role play a fake example here with Christina and Rami, acting as if, you know, they're the clients I'm sitting here with. Because with this concept, once you get it, you get it. If you don't get it, you don't get it. But there's questions that are asked that helped me understand it a lot, because I literally did not understand this concept going from captive to an IMO. I didn't understand this concept at all. And I lost a lot of money and I didn't help a lot of families at that point. But once I got it, I'm like, the 78-year-old mortgage lead is my favorite lead, right? So, and I'm not joking. So I'm going to go ahead and role play with Christina and Rami. So guys, thanks for hopping on with me and kind of just being willing to do this role play with me. So I'm going to, if you guys can unmute yourselves, that would be awesome. So we're going to do like an actual role play as best as we can. I'm going to act like I don't know Rami and Christina, that they're husband and wife. They're going to tell me that they're a little bit older than they are, only a little bit. And we're just going to kind of walk through what that looks like, okay? And if anybody has questions as I go through, of course, ask away. That's what this call is for. It's meant to be interactive. So with that being said, Christina and Rami, thanks for being on with me today.
Hey.
Hi, how are you?
Hey guys. All right, so essentially going to the home, we're looking at, in this case, a mortgage protection appointment. I do want to be clear that this can also be applicable if you have clients who are, you know, in that age group or their health simply doesn't qualify them for a term product. I know I've had people be like, I want $1 million of insurance. Then I'm like trying to find the $1 million for a 75-year-old who, you know, had a heart attack a year ago. That's it's not going to happen, guys. Like it doesn't happen. It's not realistic. So we want to be realistic with our clients, right? So when I'm laying the foundation in terms of mortgage protection, most of you, if not all of you guys, have definitely heard my role and purpose. If you haven't, please tune into more calls. No, I'm half joking. But essentially, I'm just going to go in. I'm going to do my role and purpose as normal, right? I'm going to, you know, shoes on or off, kitchen table's that way. I have no idea where it is. They direct me to the kitchen table. And now I'm sitting in front of, in this case, Christina and Ron. All right. So I'm going to show them the form. I'm going to say, you know, Rami, I know we spoke a little bit on the phone about this form when you had filled it out. And when you did fill it out, Rami, what was just, you know, your biggest concern that you had?
Just wanted to make sure if anything happened to me that Christina would be taken care of and she'd be okay.
Okay, so just really making sure, Rami, if something happens to you, Christina would be okay with the home?
Yes.
All right, I hear you guys. So before I go through anything with you, I just want to tell you, you know, who I am, my role, my purpose, and really what I'm here to help you guys to accomplish today. So I'm what they call a field underwriter or a broker. And that just means I work with about 80 or so different companies that do these mortgage protection plans. So my job really is to be an advocate for you guys, and right now about 15 others in the area, to get you the lowest rate based off what we're looking to cover, if coverage is necessary at all. So I'm going to talk to you guys a little bit about the mortgage itself, just to make sure, you know, I do understand how it's set up, a little bit about finances and plans you guys may already have in place, and just a little bit about your health, not to be invasive, just to make sure, you know, whatever direction we're looking at, we get you guys approved for the coverage, we don't get you declined, okay? And now, Christina and Rami, your job really today is just to kind of help me help you. Meaning we do all have a budget, right? You know I do, I'm sure you guys do, and you know, the guy down the street probably does, right? So we want to make sure whatever we're looking at will suit the need, suit the budget. We'll do our best to make those work together, okay? Rami and Christina, we're going to go ahead and take that application today and get it sent up to senior underwriting for final approval. We typically have an answer back, sometimes right here in home. If not, usually about 1 to 3 business days, and the coverage will be in place for you guys. Sound good?
Yeah, for sure.
All right, great. So let's see. Christina, I have here that you are 72 years old. Is that correct?
Yes, that's correct.
All right, great. And Rami, you're also 72.
Yes.
Okay, awesome. And we're both non-smokers?
Non-smokers.
Yep, we don't
All
smoke.
right. Great. And then let's see, I have here that the loan amount is for 250,000, is that correct?
Yes, that's correct.
All right, and it was a refi, yes?
It was, yes.
All right, awesome. And in terms of your monthly mortgage payment, roughly what does that equate to?
About $1,500 a month, Marysa.
About 1,500?
Yeah,
And
including
that's with
tax.
your, all right, everything included, taxes and insurance?
Yes.
Perfect. And you mentioned that's on a 20-year note, yes?
Yes.
All right. And let's see. And then in terms of equity in the home, you know, if you guys were to put the home on the market today, what do you think it would sell for?
Probably like 550.
About 550. Awesome. So you guys have $300,000 of equity in the home. That's
Yeah,
awesome.
give or take. Yeah,
Yeah.
probably right around there.
I agree.
All right. Well, bare minimum, we want to make sure that that's protected because I know how hard you guys work for that. All right. And now Christina and Rami, are we both retired?
We are, yes.
All right. What do we used to do for work?
I was a teacher.
All right. What about you, Rami?
I was an anesthesiologist.
All right. So you both helped a lot of people, yeah?
We like to think so.
Awesome. Love it. And in terms of income on a monthly basis, Christina, just on your end, roughly what do you have coming in after any taxes are said and done?
Probably about $1,200.
Okay. And is that your Social Security, your
It is.
retirement, your pension, your Social Security?
Yeah, my Social Security.
Okay. And Rami, how about on your end?
So my Social Security is about 1,800 and my pension's around 3,000.
Okay. And on your pension, Rami, did you take the max benefit or did you take a smaller benefit? Or did you take the smaller benefit?
I think I took the max. I'm not too sure. They didn't really offer me at that point. I just said, you know what, give me the most money I can get when I retire. So you tell me, did I take the max?
Okay, so it sounds like you probably took the max benefit, which means, Rami, you know, when you die, your income's going to die with you, right? And I'm sure you guys may be aware of this. I always just like to, you know, make sure my clients are in tune. In the event that something happens to either one of you guys, they're going to take the higher of the two Social Securities and the other one is going to be eliminated. So, Rami, if something were to happen to Christina, your income would stay the same, but you would lose Christina's Social Security. Does that make sense?
Yes, it does.
Yeah.
And now, Christina, on your end, if something were to happen to Rami, they would give you the 1,800 of Social Security and bump it up. However, you just lost Rami's pension.
Yeah, we realize that.
Okay. All right. Okay. So the income fluctuation is significant, right?
Yeah.
So Rami, with you having about 4,800 coming in, and Christina, you having about 1,200. Fair to say combined household income is about 6,000.
Yeah.
Yes.
All right. Awesome. And then in terms of just regular life insurance goes, what do you guys already have in place?
I don't have anything in place currently at this time.
Okay. Well, I'm happy I'm here.
Yeah, I don't have anything in place either. I lost everything when I left my teacher position.
Okay. So you had your benefits on the job.
Yeah.
Okay. All right. Yeah, we all, a lot of people learn that the hard way. I'm sorry that you were in that category, but again, I'm happy I'm here to help you guys today. And then how about anything that would offset the mortgage if something had happened, like a 401k, IRA, significant savings, anything of that sort?
No, not on my end, not really. No significant savings either. So no protection at all in your.
Yeah, nothing really significant. Nothing
Okay.
that was going to cover the $250,000 mortgage.
Exactly.
All right. So it wouldn't be looking so good. All right. I understand. I'm with you guys. Now with that being said, you know, there's 3 types of mortgage protection. Okay. And I'm going to go through those with you guys. However, I just want to make sure that I'm clear on that. It's not just that one type of the full payoff. Okay. But in terms of health, when about is the last time you guys saw your doctors?
I saw my doctor about 3 months ago, just for a routine.
About 3 months.
physical.
All right. Awesome. And how about you, Rami?
The same. For my.
Okay. You guys go to the same doctor?
Yes.
All right, great. And fair to say you guys go at least one time a year for that annual checkup?
Yeah, for sure.
All right, great. And Christina, on your end, how about any medications that you're prescribed or taking daily at this time?
I take lisinopril for high blood pressure. I've been taking that for about 5 years, give or take.
Okay, and do you know the dose on that? Is it like a 10 milligram? Or
It is, yes.
10 milligrams one time a day? Okay.
That's all for me.
All right, and then Rami,
Rami
how about
takes
on
a
your
few
end?
more.
I do. So I've had blood pressure. I take amlodipine and metropol altogether, and I'm a
Okay.
type 2 diabetic, and I'm currently on metformin, but I do not take insulin, and it is regulated, and my A1C has not gone over 8 anytime in the last 10, 15 years.
Wow, you definitely must be an ex-physiologist. Okay, all right, got it, Rami. So, and you're using the 2 blood pressure medications, diabetes type 2, diagnosed after the age of 50?
Yes.
Okay, great. And no complications with the diabetes, just working with your doctor,
Yeah, not
using that
complications.
metformin?
Complications, correct.
All right, awesome. So with that being said, any past scares, cancers, heart attacks, strokes, lupus, anything scary, hospitalizations, COVID?
Nothing like that. I was hospitalized just for a knee surgery, but that was about 6 or 7 years ago, but nothing like medically, no cancer or heart history or anything like that.
All
Same.
right, well, that's awesome. Okay, well, that's great to hear. You know, you guys are 2 very healthy 72-year-olds. I'll definitely give you that. All right. So I'm going to pull up some options for you guys. But before I do that, I always just like to make sure that I'm understanding, you know, really kind of why I'm here today and the best way to help you guys.
Okay.
So based off of the income differentiation, and, you know, I think you guys saw that right away is, you know, if something should happen to you, Rami, it looks like, Christina, you're not going to be in the best position.
For sure. Yeah.
Okay. All right. And tell me a little bit about what that would look like, you know, if Rami had died last night.
I mean, financially, it's obviously going to look a lot different without having his income. As far as like the home goes, I think it'd be a lot of home for me to have without Rami being here. I do have a daughter that lives somewhat close by, so I would like to stay in the area, but I don't necessarily know if I'd want to stay in this large of a home.
Okay, why do you say that? Like you would downsize or?
I'd probably downsize, yeah, just because I mean, financially, I'm not sure if I'd even be able to afford the mortgage and whatnot without Rami, especially being that we just did refinance the home already.
I hear you, but with all that equity in it, we got to make sure it's covered, right? So you'd probably sell the home. Okay. And Rami, correct me if I'm wrong, you know, both of you guys here, we're more concerned if something should happen to Rami to make sure Christina's protected.
Yes, especially after you explain the income and show me this discrepancy, then yes, I definitely agree that we definitely need to make sure I'm protected to ensure that Christina can maintain this mortgage and keep the home that we've built and put so much money into.
Yeah, for sure.
Okay. All right, I hear you. And Christina, I guess, what would it look like if, you know, again, Rami passed last night, like, where are you going? Are you going to stay with your daughter? Are you going to, like, you're going to sell the house immediately, short sale it? Like, what's that going to look like?
I think I'd have to sell the house. Yeah, just because like I said, I don't think I'd be able to maintain the bills, like the mortgage, the utilities, the taxes each year, all that. I don't think I'd be able to maintain it. And I don't know if I necessarily would even want to, just because it's a really large home for me to live in by myself.
Absolutely, and a lot of memories and things of that sort. With the monthly mortgage payment being $1,500 a month, and then your income, if Rami should pass, would go to $1,800. I can understand why there's a concern. I understand now why I'm here, okay? So Christina and Rami, there's 3 main types of mortgage protection coverage, okay? The first type is what we refer to as a full payoff. It's exactly what it sounds like. It means if something should happen, that whole $250,000 would be paid off. Now, in theory, that sounds great, but it's really not always necessary, okay, guys? The second type is what we call a partial payoff, meaning that we're going to pay off X portion of the home, whether that be half of the mortgage, 2/3 of the mortgage, to make sure that there's always going to be something there. And the third and most common type of mortgage protection for folks in your age group is what we call a critical period or an equity rescue plan. And essentially what it's going to do, it's going to make sure in that critical time that you're, harping the loss of a loved one, that you're not worried about what's going to happen to the home. In that critical time, you're worried about, the mortgage is paid, you're worried about grieving your loved one, and you're worried about, being able to move forward. You can grieve properly, right? That is the goal.
Yeah, absolutely.
Okay, I'm just saying all my clients in real life, they're all like, yes, that is the goal. I want to be able to grieve in peace, right? So back to me role playing with you guys. So we want to make sure, whatever position we're putting you guys in, it's not me telling you what you want to hear and that, you can pay the whole $250 off and it's going to cost you $250 a month. That's not the case, okay? And we want to make sure that we're not making you guys insurance for, okay? So with that being said, I'm going to run up a couple of options. So bear with me just a minute. And then I'm going to, run through a couple of options. I'm going to make sure I know what direction to go.
Okay.
So what I'm doing here on my back end, so to say, based off of the income, right? We always have to look at that, because if the household income is $1,000, which it's not in this case, we cannot be pitching somebody a plan that's going to cost them $200 a month. That's like, you know what I mean? Like, you just shot yourself in the foot. You should just leave. Like, love you guys. But it's not going to work, right? And we want to also make sure we're keeping good quality business. So in this case, equity rescue critical period, what does that mean, right? You might be thinking. It means we're going to cover the mortgage with the whole life product. I want to be so clear on that. We're using whole life. And all we're doing is we're taking the monthly mortgage payment, which in this case is $1,500. And we're going to show them, we're going to take 1,500 times 6. Okay, I'm not that good at math. I'm like 9,000, right? So we're going to show them $9,000 of whole life. It's not what it is, it's what it does. $9,000 might mean nothing to you, but it means something to this family because it's going to make sure she can put the house on the market. All right, so I'm going to work up a couple options based off of their income being $6,000 as a household. I'm going to want to make sure that I keep it in a good stance, so to say. However, that's not too low. In their case, I'm going to start asking more questions. So I just said the 3 types of mortgage protection, right? So Christina, I know you talked to me a little bit about how, if something were to happen to Rami, you would probably downsize on the home. Is that right?
Yes, I think
Okay.
I definitely would.
And I know right now, the housing market looks good. It's a seller's market, et cetera. But how long do you think it would take you to actually get the home on the market, clean up the memories that you guys have had, so to say, for, 20 plus years here in this home, and be able to leave on your own terms and instead of the terms of the bank? Like, how long do you think it would take you to truly be able to go through that grieving process, Christina?
I think, with the way the market looks now, maybe about 6 months or so, but obviously we know the market fluctuates. It may not always look like that. So I'd say upwards more towards like maybe 9 months or a year, just because I'd want to have the proper amount of time for sure.
Absolutely. So what I'm going to do, because Christina, how much help would it be for you to have, 6 months, 9 months, or a year's worth of mortgage payments while you figure out, what you're actually going to do?
Yeah, I think that'd be really helpful. That makes
Right?
sense to me for sure. Yeah.
Okay, awesome. So at that point, like, guys, like, all I did was talk to her, right? Talk to them. I had a conversation, and this all goes back to, it's not what it is, it's what it does. This is a mindset thing. If you think $9,000 of insurance isn't going to help somebody, I'm not being mean. Like, you're like, I don't know, right? You're in the wrong place, man. Like, because we help folks with final expense insurance for $5,000, and that's a big deal to them and their family. So the way that I'm going to go ahead and pitch this, because I already basically sold them, right? Like, Rami's over there like, yeah, like, just like almost listening in. And Christina's saying, I asked her, how helpful would it be to have 6, 9, or 12 months mortgage payments? And she's basically like, wow, oftentimes folks' eyes will light up like, I didn't, like, that's exactly what I was looking for, but I didn't know what I was looking for, right? So it's going to always go back to, it's not what it is, it's what it does. So I want to be clear on how I pitch this. So I always am a big 3 option person, okay? So what I'm gonna go ahead and do is I'm gonna calculate, again, we're taking the monthly mortgage payment. $1,500 times 6, $1,500 times 9, $1,500 times 12, right? All in terms of the premise that we just went off of. The reason why I like to ask Christina how long she thinks it would take is for 2 reasons. I want to know that she's with me and she understands the concept. I also want to know where her head's at. If she thinks she can sell the home in a month, I need to let her know like that isn't necessarily realistic, and it's probably not really what we're wanting to do here. Or have to ask better questions, right? So essentially she gave me a premise to go off of. She said probably like 6 months to like, that's what she said. And they usually say something like that. So the way I'm going to write it out is I'm going to write out, and this is where people like lose it, I feel like, in the home, and they'll call me and be like, well, the guy wanted 250 or nothing. It's like, well, you didn't, lean in with your client. Like, what do they really need, right? So at that point, I'm going to say, okay, guys, so, this option is going to make the most sense, for your family. And 99% of folks that are in your age and in your situation, having that $300,000 of equity, being 72 years old, on a 20-year note, this is the most common type of mortgage protection coverage. It's going to make sure Rami and Christina, in that critical time when Rami's no longer here with us, that you have time to grieve his death and you're not worried about the mortgage payment. You know that you have 6 months of mortgage payments, okay? So I'm going through now and I'm showing them, all I write is this. I write 6 months, 9 months, 12 months. I do not put numbers yet because I need to make sure they understand it's not what it is, it's what it does, right? If I write down 9,000, 13,500, and 18,000, they're going to be like, on my $250,000 mortgage, they stopped listening, right? So it's not like I'm not going to tell them, but in the beginning, it's like how I don't show prices. I need to make sure they're with me. So I'm going to say, okay, Rami and Christina, so back to us here. So Rami and Christina, I want to make sure, you guys are with me, right? So the monthly mortgage payment is $1,500. And now, Christina, correct me if I'm wrong. You mentioned to me you would want at least 6 months to be able to gather everything and make sure that you guys can leave on your own terms versus the terms of the bank. Is that right?
Absolutely.
And it's really smart, and I applaud you guys for filling this out and just really getting the information, because people lose equity in their home every single day when they lose a loved one, right? They lose $300,000. I don't want that to happen to you. So what we're going to do is we're going to lock in and make sure that is never going to happen to you, Christina, okay? So Rami, what we're going to do, we're going to cover you, and I'm going to show them the paper, I'm going to make like this. That's how I pitch. You got to show people things. People learn differently. So you're going to verbally speak it, but you're also showing that. I literally write 6 months of payments. That's it. 6 months of payments, 9 months of payments, 12 months of payments. That's all it says. And at the top, it says whole life / permanent coverage. That's all that is on my pitch sheet so far. So I'm going to say, okay, guys, so I'm going to walk you through this, okay? And again, I'm sure you guys don't talk about this every day. So if you have any questions, please don't hesitate to let me know. Just stop me, okay? So first and foremost, I'm going to go through options A, B, and C here with you guys today. So what's important to know about all 3 options is they're whole life or permanent options, meaning this option's never going to expire on you guys. It's always going to be there. Nothing ever goes higher or lower. It's nice, even keeled, and it's locked in. Do you guys have any questions about that?
No, that makes sense.
Makes sense? All right, perfect. So Christina and Rami, looking here at option A, we'd be looking at covering you guys for 6 months of mortgage payments. So in the event, Rami, were to die tomorrow, you're going to have 6 months of mortgage payments to make sure, again, Christina, not only you can leave on your own terms, on the terms of the bank, but you're going to be able to pull the equity out and be able to sell the home at the rate that it should be sold at. You're able to sell the home to somebody that you'd want to have this home. You have a lot of memories here, right?
Yeah.
So whoever buys the home, would that be important to you?
Yeah, of course.
Because I know, like when I lost my mom, like the person who bought the home, that was really important to me. And I didn't have a say in it. And it still breaks my heart till this day. So I want to make sure you always have a say in that. Okay, Christina?
Okay.
We're using stories. Okay, guys? So 6 months of payments is going to make sure exactly that, Christina. You have 6 months to make sure that you're leaving on your own terms, not the terms of the bank. And also, when you sell the home, what's going to happen? You said it's going to go for about $550 today. Of course, we don't know when Rami's day is, right? But it's going to go for $550. So after you're making your payments, you sell it to the buyer that you want to sell it to. You're going to be able to take the money and the equity out of this home and also have that. Does that make sense?
Yeah, absolutely. That definitely makes sense.
It does.
Okay. And then anybody else on here, and please guys, feel free to unmute yourself, because this is meant to be like proactive. Does anyone have questions on what I'm going over right now? Does anything not make sense to you guys? And it's not stupid. It didn't make sense to me for a long time.
Oh,
All
it
right.
makes sense. Yeah.
Awesome. All right. Appreciate you guys. All right. So I'm going to show them 6 months, and I'm painting pictures through this. So Christina, you're leaving on your terms, not the terms of the bank, right? That's really important. On the terms of the bank, you don't get your equity, right? They're bought in. They're like, yeah. Okay. And then option B is just giving you a little bit more time. Like I said, you have 20 years of memories in this home. I can only imagine, packing it up, and without, your loved one, right? So this would cover you for 9 months of payments. So making sure if something happens to Rami, 9 months of payments is always going to be there. And then option C, we're covering you for 12 months of payments. So making sure that, again, you're leaving on your own terms, 12 months of payments, it's always going to be there for you. Any questions on this, guys?
So one quick question on Marysa. So if something happens to me, does the mortgage lender get the money or does Christina get the money?
So I feel bad because I may have lost you a long time ago, Rami. So essentially, the goal of this is to make sure that Christina is able to upkeep the mortgage payments so that she can leave on her own terms. Christina is able to sell the home, and Christina is able to get that money. Whatever's owed to the bank, of course, is going to have to go to the bank. But the equity you guys have in the home is what we're rescuing here. So bare minimally, Christina, you're going to be able to leave on your own terms. And as of today, give or take, you're going to be able to have $300,000 of equity that's going to be coming back to you, whether you're relocating or whatever you need to use that money for. Rami, does that answer your question?
Yeah, so this is more similar to life insurance, I guess, than more mortgage protection.
It is similar to a life insurance. And Rami, life insurance or mortgage protection, essentially it's a concept, right? So any type of life insurance is a concept. We can call it burial insurance, mortgage protection, you fill in the blank, income protection, college fund protection. It is a life insurance plan, but we're gearing it particularly to your mortgage. Does that make sense?
Yes, it does.
Any questions about that?
No, makes sense.
Okay. All right, beautiful. So going back to option A, that 6 months of payments, going to be $9,000 of coverage, okay? And again, we're going back to, it's not what it is, guys. It's what it's going to do for Christina when you're no longer here, Rami, okay? And then looking at the option B, it's going to be $13,500. Option C, $18,000. Now, in the event, Rami, that you should pass accidentally, it's going to go ahead and pay out double. Natural clause is going to be 6, 9, or 12. Any questions? All right. So I'm going to say, all right, so we're looking at option A. I gave them the actual amount. Again, it's not what it is, it's what it does, right? So at that point, okay, I'm going to say, so Rami and Christina, being that everything makes sense, which it looks like it does, and you guys told me you had a need for it.
Mhm.
Which one feels best, Rami, to protect Christina, both budget to need wise?
So I definitely wouldn't want to give her only 6 months of time. I don't think that would be fair because God forbid it took a little bit longer. I want to make sure she has enough time. I think a full year. I don't know, Christina. I think 9 months would be pretty good.
Yeah, I think a year makes sense just because, like I said, right now the market is booming, but we don't necessarily know if that's what it's always going to look like.
Exactly.
I think a year
Okay.
is fair, and that fits our budget too. So I think that makes sense.
Okay, awesome. So just grab your driver's license, Rami, and a voided check, and I'm going to get the application going with you guys.
Bye.